We start off with the Chartmaster's big warning on Apple. His latest note calling an end to the tech giant's 8-week run in which it gained nearly 30% and climbed within 5% of its all-time high. Let's bring in Carter Worth of Worth Charting. Carter, our viewers know you quite well. You're a man who is level in your emotion, and yet this call went out today and it had exclamations in the headline, and that really caught my eye. So walk us through.
Well, hold on. Yes, but no exclamation points. I hold back on those, but certainly in fact, to write sell it all is certainly definitive, right, and emphatic. And here's the thing. We know, before we look at the charts, we know that what makes a market is just exactly what you see in Apple. It's the largest stock out there. It's 7.3% of the S&P, and it's covered by some 40, 50 analysts. In fact, there are people whose 12-month price targets are as high as 220 and as low as 140 from top 10, top 5 brokerage firms. And there is the rub. How can one man or woman or one analyst think it's worth 220 and one think it's worth 140? With the same access, the same information, the same spreadsheets and Q's in case. And then here's a technician. I'm sure the technicians that want to ride the momentum, my thinking is, this technician, that it's just too steep, uncorrected, almost unnatural. Let's look at some angles. So the first chart is a comparative chart, and it's just Apple versus the QQQ. It's peers, if you will. And it's a one-year comparative chart, and we know the spread is what it is. The numbers are Apple's up 16, 70%, the Q's down 10. If we take this back a bit further, take a look at a 5-year chart. We have the same spread, meaning Apple outperforming the QQQ, of which is, of course, a big part. So there is some autocorrelation. But Apple's up 340%, Q's are up 130. Or the 10-year final comparative chart, we know that, again, Apple has more than doubled the other large 100 stocks in the NASDAQ 100 represented by the QQQ. So, but the here and now is what sort of gives me pause. Let's look at two charts. What we know from the absolute low of June 16th, Apple's up 35%. And the angle of the line is becoming increasingly unnatural. No givebacks, not even a down 2-day sequence. And so not only do we have that sort of unnatural line, we are up against a downtrend line, which is annotated quite clearly there on the screen. It also is otherwise known as a megaphone. Forget about what that kind of talk is. It's a move to a difficult level. And if you pull this back and we do one more chart, it's just putting this in the context of going back to a pre-pandemic wipeout. And so, again, there'll be people who say, no, you stick with momentum, you ride it until it starts to show you reasons not to. My thinking is that to some extent, this is almost the face of fear. People are hiding or wanting to be in this particular stock, maybe at the exclusion of all others. For instance, of the stocks in the QQQ, there were only 10 up today, but Apple leading the way yet again. Just a little too popular, a little too happy, a little too good.
Could fear, Carter, in this market context that we're in, keep that unnatural line unnatural?
Well, I mean, certainly you can get, as the expression goes, overbought or oversold and stay that way for great periods of time. But if one were to use oscillators, I don't particularly, but you could look at a MACD or an RSI, you could look at a Bollinger Band, or one can just look at where this is in relation to where it's been. A move like this is hard to sustain much longer. And at a minimum, if one's long, you take a little off, or you write some calls. Or if you have the dexterity, you try some options to do something rather than just blindly stay long.
Right. Carter, thank you. Carter Braxton Worth, and we have to do a correction here. There is no exclamation point. I looked again, but I felt
emojis, maybe?
I felt the emphasis in Carter's tone in the note. It came through the email and leapt out at me. Dan Nathan, what do you make of this?
All right, well, listen, I got this email from Worth Charting today, and I immediately thought about dexterity, okay? There were actually exclamation points in my head because I've been looking for a reason why this stock should correct a little bit. I agree, that slope is unnatural, and when you think think about that 35% rise that it's had, that's pushed this valuation. I know Tim will have a lot to say about this. 27 times for a company in the out year. Okay, so we're 1 quarter away from their fiscal 2023 earnings and revenue guidance. They're expected to be mid-single digits here. So when you think about how unnatural of a move that is, maybe it gets back to that 182 all-time high on January 2nd. Maybe it gets back, maybe only to 180, the high in March or so. I think the risk reward sets up really well to the downside here. I bought puts in September, looking out a month. If you look at implied volatility, the price of options right now at 24%, in line with the historical vol, how much it's been moving. That says to me that directional bets using options long premium looked very attractive. So that's what I'm doing. I'm looking down. I'm risking about 2% of the stock price over the next month for a 4% break even to the downside. I like that risk reward here.
So I've been flat of Apple. I got out at around 164 on the way down, and I was talking about 125. I was talking about levels that we largely got to, but I'm going to echo a lot of support for the same call here. Again, you had 175 to 180, the highs you hit in December, then in January, then later in March. I think there's a ton of resistance up there, but more importantly, it is at 27 times here. This is a company that part of the argument here is this is the greatest pull forward story, I think, in history. I know we've talked about COVID has-beens and those that have been in the sweet spot. I just think that Apple and Apple demand is not something we've heard anything about. We've heard about supply chain. We've heard about China. We've heard about this and that. We've heard a little bit about some pressure in the services business and where we probably won't see some of the same recurring revenue. But again, this re-rating in Apple has been all about the services revenue over the last 3 or 4 years. And you have to ask whether that can be there. So on multiple, I struggle with it. It's outperformed the S&P by 16% since that June low, and it doesn't make any sense. The only side of this that worries me is that if you look at cash levels, whether you're looking and you're reading Bank of America's fund manager survey, or you're looking at we're still at very, very high cash levels, at least in the institutional community. And this is a stock, again, you don't get fired for missing the way down. You get fired for missing the way back up. And I think there are managers that still feel like they have to own this.
How about the reports that Apple has signaled to suppliers that it plans to sell as many phones as it did last year, Karen? And the cash on the balance sheet. Shouldn't this stock have a premium because of how fortress its balance sheet is in this market environment?
Yes, it should have a premium, and obviously they do have a gigantic cash hoard, but all of that is known and already should be reflected in the marketplace, right? They told us that about how many phones that they could sell as many phones as they could. So I think all that's reflected in it. So normally I don't like to trade around a long-term holding, but I actually looking at the multiple here, because remember, a big part of this multiple is hardware multiple, which should be much lower. So that means you're getting a much higher multiple for the services. And in this environment and with rates going up, I feel like the multiple is too high. So I will look to buy some puts instead of selling it. And if you're a long-term holder, you can buy puts, and you don't need to realize a gain. It stops the clock, but if you're already long-term, it doesn't matter. Ultimately, when you do sell it, it will still be long-term. So it's tax efficient for me to buy a put, and I think that's what I'm going to do, buy puts against my position, because it has come too far, too fast.
Guy, excuse us. We're on television right now. Yeah. Are you actually on the phone?
No, I'm actually putting on some hedging strategies.
It is after hours, so you can do that on certain trading platforms, apparently. What do you think of this call?
I just cracked myself up.
He sure did.
If we played the game, which we love to do.
No one else, apparently.
If you didn't know what company it was, and you just had all those, and look, you're talking about a company with 6.5% EPS growth, maybe. 4.5% revenue growth, maybe. That trades to the aforementioned 26.5 times next year's numbers. In an environment where it just went up 34% in basically 2 months, in a rising interest rate environment, while the Fed is continuing to raise rates, with a consumer that is seemingly levered with a $1.1 trillion now in credit card debt, unemployment probably going higher. This is a stock that, believe it or not, does go down as well. We've seen it a number of times over the last years. This level makes as much sense as any. And please don't @ me on Twitter. I can't do it on this Thursday night, but I'm with Carter Worth on that one.
It's not Thursday, is it?
It's not Thursday.
So we can go ahead and
Wednesday.
actually.
I know it's Wednesday. I'm kidding around.
In terms of the bricks in the bear case for Apple at this point in time, I mean, Tim, you had mentioned the greatest pull forward story, but I'm also wondering about the consumer. If you're a cash-strapped consumer, you love your iPhone. You will do anything. You will not eat a meal per day and keep your iPhone and keep your cell phone service, but at the same time, you might cut back on services.
I think that's right. And I think, again, a lot of these Apple services were even Apple Care and things that people bought during a period where they bought new devices. I mean, these have a runtime to them, and maybe you can argue that they're going to have to reinvest $119 to get the 2-year warranty. But I just think that the consumer at some point has a watch, has an iPad, has an Air Pro, has a lot of these things. It's the iPhone that we talk about, hardware as a service, that I do think can continue to be almost a subscription kind of a revenue. And we've seen with their ASPs, they're getting those higher numbers. That's why the stock trades at the premium it does.
Yeah, I'll just say this. Again, it's become a utility. It is a luxury utility, to your point. It's not something, and I think the way that they've done the upgrade program, it's not something that people think of. When we talk about that average selling price, most people are not going out and paying $858 or whatever the ASP is right now. But I think with 1.8 billion installed base, that's the bull case for the services, that you're going to continue to grow that installed base. You're going to continue to have this higher blended multiple, right? Right now, there's a 43% gross margin. And let me tell you something. There are very few hardware companies in the history of the world who have been able to maintain that. This company has been growing that because of the services, because of the installed base. I'm not bearish on the company right here. I'm bearish on the stock. And I think that's really important because the stock makes no sense in the context of the market environment that we are in right now. So,
but isn't this a market call? I mean, at the end of the day, because if you were bullish on the market, you get out of the way of Apple moving higher.
So you know what? So in May and June, when I started buying the QQQ, I was effectively buying Microsoft and Apple and some of these big names that were down 30%, and I thought it was a little much for them. But I don't like the straight move higher 35% or so. And I also think it's a little bit of a ringing the bell. Apple is basically down 1% on the year right now. I don't think anybody in May or June thought that there was a high probability of that happening in 2022.
I like the idea of differentiating. This is a call on the stock as opposed to a call on the company. But at the same time, Dan, it sounds like you're skeptical of some of the aspects of the company in terms of hitting forecasts.
Well, I never believe in this like super cycles, okay? Like 5G, just so you know, people, I mean, I've been saying this for 5 years now, the stock's gone up, was not a super cycle. It's just a thing that people do. They gravitate towards the next technology that's there. So we've never seen that sort of thing. So this new 14 Pro that's coming out, people, on September 7th, I mean, it's going to be very much like the 13 Pro
These people,
and the 12 Pro.
like four times.
I have, because I get a little hot here. I mean, but listen, I guess the point is, what's your time horizon? In about 40 minutes, Jim Cramer's going to come on, and he's going to say, don't trade it, own it. And he's been right about that. And the stock has 30% peak to trough declines plenty of times over the last 7 to 10 years or so. So if you never did anything and you're right back here at $175, you're fine. If it's the sort of thing that you don't look at the volatility in the stock.
Quickly, Karen, are you bearish on just the stock or the company as well?
Just the stock. Find myself in the uncomfortable position of agreeing with Dan entirely.
That really says something when Karen agrees with Dan.
And she points it out the 3 times it's happened in the last decade. So
she keeps a tally. That's all.